What do you see of forecast prices ROI in the next 2 to 4 years? I think it's time to talk about our old friend, MOI.
There we go. Happy to do that.
Why don't we go through this in the context of this, and then you can speak directly to it.
Love it. So as we have gone from macro, how to think about real estate more as a recurring pattern of slow but repeatable growth in terms of home price appreciation, we could go a little bit more micro into how are we doing, what part of this cycle are we, or what part of this recurring pattern of growth are we in? One chart to be able to do that was a chart that we just looked at that we just looked at. But there's a whole nother world here that you should be looking at. And we talk about it often. And it's so amazing that we have over 90 people attending live on the show here. Some of you are brand new and you've never heard me talk about months of inventory.
That's right.
But our veterans in the Not Your Average Investor community have heard this over and over again. And it's so important that we go into it all the time. Yeah. Months of inventory is the tracking of how long would it take for the market to be exhausted, for all the properties on the real estate market in your area to be exhausted based on the current rate of sales. And if you track it over time, this is an early indicator for what home prices are going to do, call it over the next maybe 6 to 12 months. This is another tool that we use to be able to see what is going to happen with home prices in the very near term. And so all you do is you take the number of homes that are on the market, divided by the number of homes that sold last month, and you're left with a number. And this number is your months of inventory. And if that months of inventory number is less than 6, you would expect higher than average home price appreciation, call it over the next year. If it's between 6 and 7, historically, you'd see about average home price appreciation. What's average home price appreciation?
We just talked about in the chart, 4% in Jacksonville.
I'm going to give you one more try.
4.6%.
I'm going to give you
5%.
The actual average home price appreciation in Jacksonville over the last 40 plus years is actually 5%. But when we started, it was less than that.
It was 4.6.
It has gone up over the years. So that's what you would expect between 6 to 7 months of inventory. And if you get up above 7 months of inventory, that's where you would expect lower than average home price appreciation. It does not mean a decline in home prices. It might mean 3% or 4% or 2%. And as you get farther and farther away from 6 to 7, that's where you start to see a quote unquote bubble potentially starting to form.
Got it. So that is the stat that when we first started this show, for those of you that are new, we started this show January 2020.
We did.
So as you can imagine, as March 2020 rolls around, we're just kind of like getting into this. Greg and I barely knew each other.
Yeah, we did.
We're getting into this. So like, yeah, we got a community and we got a show. We're talking about stuff. All of a sudden the world ends.
Yeah.
Right. Like where we were yesterday was all of a sudden we're in complete outer space. And as everything is melting down around us, we knew that there would be a lot of eyes on the show. And that's what happens. That's when you are able to host a community every single week and you have a press conference. You get the most people when stuff goes wrong, right?
Yes.
And stuff went really wrong. And I was going into this thing and we're just talking about, he's like, hey man, I know that everybody's freaking out here, but I just don't think prices are going to drop. Like if you look at this months of inventory thing that we have, I don't think it's going to happen. I'm a little bit nervous talking about it because I don't want to, because I'm flying in the face of everybody out there in the media, but like, this is what we look at. I'm like, Greg, go for it, man.
You did.
And kudos to you. You leaned into it, right? So like, this is why we call this the Not Your Average Investor Show. It's because you're not getting like an average real estate kind of perspective here. You're getting the perspective of somebody that thinks independently, has his own data, makes his own decisions, has been doing this for 17 years, and has now built part of more than $1 billion worth of passes and transaction. And this is one of like the big marker stats that our community has really grown to understand and love. And let's dive into it, right? This months of inventory right now in 2019, again, you divide the houses on the market by the total sales previous month. 2019, it was at 3.19, which is considerably below the median trend of 5%, right? You look at January 2020, again, you divide the same thing, you're at 3.0.
January 2023.
January 2023. Yep. I'm not a numbers guy, Greg. I'm a story guy. And we're at 3.06. And we look at January 2024, and we're at 3.24.
I think it's interesting. What has the narrative been around real estate in January 2019 versus the narrative around real estate in 2023 versus narrative even now?
January 2019, real estate looked phenomenal.
Everybody wanted to buy real estate then.
Everybody was buying real estate. And somewhere in the last year or so, the media has completely turned on it and said impending crash. You know, like you get all these different headlines of like all this impending doom and gloom. And yet when you look at these numbers here, that MOI indicator is staying as saying prices in Jacksonville do not look like they are going to drop anytime soon.
Just to put this in perspective, it is so unusual to see months of inventory in the low threes. It's so unusual. You know, before this, really, we started tracking this in 2014. Consistently, it's in the 4s, 5s, 6s, somewhere around there. I don't even think we saw it in the 3s for many, many years. And now it's still in the 3s, which means that we have a supply challenge. It is a problem for America because we don't have enough housing supply to support the demand for housing. But for you as an investor, it puts you in a position of strength when you own the asset. It's like any other business. If you have the stuff that there's not enough of, you're in a position of strength. And what it does is it keeps a high floor of pricing. So when I get the question about what's going to happen over the next 2 to 4 years of pricing, well, I don't know exactly what the Fed's going to do with interest rates, and I don't know what's going to happen with the world wars and all of this stuff that is happening around. One thing I do know is that we have a supply problem. And when you have a supply problem, that is inherently keeping a high floor for prices. And so what I'm very confident in, and we've said this for a long time now, is that home prices 3 years from today are going to be significantly higher than what they are right now. And I think that a little bit of that is missing the point too. The point here is if this asset class is right for you, you buy and you hold, and you don't really worry about what happens next year, the following year, or 3 years. You should be making, at the very minimum, 5-year decisions, but really 10-year decisions or longer.
And if I was to translate that into a feeling, right, like what you just said, right, we see the MOI data, we believe that real estate prices are going to go up. I think the feeling that is most common in this community is either, man, that house that I bought for $80,000 is worth $200,000 right now. I'm real smart. Or, man, that house that Denny bought for $80,000 is $200,000. I wish I would have done it then. What Greg is saying from like a feeling perspective is this idea that if you are, you know, if you get it, right, you get it. You understand that real estate is the place where most people make their money, like most Americans build their wealth. You understand this idea of buying and holding for a long time, and you are interested in getting into real estate. Buying today will give you that feeling tomorrow. You will, the prices will continue to rise in that medium length range. We don't believe that they're going to drop in that medium length range, in that 2 to 4 year range that Shaquille was asking about. They'll continue to rise. And the other thing that this show that we've talked a lot about is this idea that when interest rates drop, that is another thing that we see as an indicator that when the Fed is dropping interest rates, prices start going up, and not just prices are going up, but the demand for real estate, the buying frenzy starts to really, really happen. And if, you know, you're looking at this months of inventory data and it's telling you, okay, still got a really, really high floor here, don't see the bottom dropping out anytime soon. And you're also looking at indicators in the economy and the signaling from the Fed and the different things that are happening. And you're like, man, I think in the next year or so, interest rates are going to drop. Then the idea is locking in right now into the price that you can get right now before it continues to go up, and then refinancing later after the rates drop will allow you to lock in all this like equity right now and getting at a lower purchase price that you can then refinance later on. And just like Marilyn, whose rental income just went up because she had somebody renew and the raises rents, you know, refinancing will create greater cash flow as well for you down the line.
Well said. I think there's a much higher chance of what you just talked about happening than the chances of home values going down.
Yeah, there you go.